Hello everybody, welcome to my channel. My name is Ryan Schul. This channel is all about data science, machine learning, artificial intelligence, and things such as this. Now in today's project, I want to look at financial market risk assessment. This is number 3. I have 5 in the entire series. This is number 3 of 5. And I want to take a look at this because there's been a lot of volatility, choppiness, and a lot of movement in the stock market recently, all driven by Trump's tariffs. Okay, so I'm sure you've seen this in the news. I'm sure you've heard about it, right? Unless you are not really paying attention, which I find that hard to believe, you must have heard about all of the craziness going on in the stock market. So I want to try to take this opportunity to understand historically what has been happening, and then try to understand also what's happening now, so we can make better, more informed decisions, smarter decisions, protect ourselves against capital losses, improve capital allocation, prepare for extreme events, boosting investor confidence, and so on and so forth. So that's the point here. So I'm going to import historical stock data for these symbols right here. This is the S&P 500. This, I think, is the what the heck is that? Some kind of index. This is gold. This is VIX. This is the volatility index. Let me see what this thing is. Finance. NASDAQ, I think. Let me see something here. Yeah, NASDAQ composite. Okay. So we have all of our stocks here. You can't actually invest in the VIX, but I think it's interesting anyway. It shows you the volatility of the market. So if you want to understand how volatile things have been in the past couple of weeks, the VIX is a great benchmark for that. Okay, this thing seems to be going a little bit slow. Okay, that's fine. We're getting something here. Okay, and the VIX, just to show you what this thing looks like. I don't want that. Okay, let me close that thing. Oh, here it is. Here it is. VIX. VIX. Okay, character. Yep. So Chicago Board of Options and Equities, I think. I don't know what CBOE is. Okay, so let's look in the past couple of days. So there's a lot of volatility here. This is April 10th. Pretty big swing there, and again back on the 8th. So for the past couple of weeks or so, the VIX has been pretty much up and down. I don't have a 2-week indicator here, but I have 1 month, so it's been up. This is up 39% in 1 week. That's a big gain in 1 week. 1 month, sorry, that was 1 month. Okay, so back to the code, Control Enter to run the cell, and I can get all the historical returns. I'm looking at daily data. Okay, and we're going back 12 months in time. You can set this to be whatever you want, 3, 6, 9, 12. You can set this to be 10 years if that's what you want. I think in this case, I think 12 months is good. We're picking up enough data that we can make some interesting calculations and use that to try to make predictions into the future about what potentially can happen next. Okay, so I have my historical data and I'm calculating returns. I get that from this right here. Okay, and then I want to look at the VaR and the CVaR. So the VaR is the value at risk. So what is the potential for the portfolio to lose value if I invest $1 million in this portfolio? Again, you can see the stocks are over here, right? I can't really invest in this VIX. I can't do it directly, but let's just pretend that we can. If I take that 1 million and spread it evenly across all those stocks, I would potentially lose 0.85%, so a little bit less than 1% of the value of the portfolio. So about 850,000. I'm sorry, what am I talking about? 8,500 would be the potential for loss with a 95-degree confidence interval for one specific day. That would be the worst loss for 1 day. Okay, so if we go down here, we can see in the next example, Control Enter, and that will give you all this code. So you don't have to try to copy it or take notes or whatever. I'll give this to you so you can copy and paste it and run it in your own Jupyter notebook. So this is a historic COVID crash going back to, what was that, early 2020, right? This is when COVID kind of first came up on people's radars right at the beginning of 2020. It actually came out in 19. That's why it's called COVID-19. It was named after That was the virus for 2019, but it was late in 2019, so we didn't really notice it until earlier in 2020. But you can see here the impact to the market when COVID came out, right? So you see like a pretty big dip in the market. But it's interesting because things came back pretty quickly right after that. And I remember that summer from April to May, June, July, August, the whole summer was very positive and the market was very bullish. So whatever we lost in early March came back very aggressively throughout the rest of the year. And then I think things slowed down towards the end of 2020 and it just kind of like ran out of gas a little bit. Certainly you didn't have the big gains and the big jumps that you had in the spring and the summer of 2020. Okay, so the next analysis we can do here is add some shocks to the system. So I'm going to artificially shock these stocks right here by changing the volatility of these. So I'm looking at JP Morgan, Goldman Sachs, Apple, Microsoft, and gold. This is that gold stock that I showed you before. Gold ETF, I think. What is this saying? GLD. What is GLD? Gold. Oh, Spider Gold Shares. Okay, so some kind of ETF, right? Let me see what this thing looks like. Yeah, okay, so that's interesting because during COVID, a lot of people are going into gold because gold is very safe and very secure. And if people are uncertain about the future, gold is a great place to be. And I think we'll see more people moving into gold in probably in the next couple of weeks if this market volatility continues. So anyway, so we have the VaR over here, okay, and again, this is the value at risk, and these are all of the let me look here. Print recorded correlation. Oh yeah, so this is the correlations between all these different stocks, right? And how intertwined or how all these stocks will move together. If one moves, this will show you how the others move, right? And if there's a big move up in one, is there a smaller move or not a smaller move, or is it actually negative, right? There can be negative correlation. So if you have a negative correlated stock, let me find one here. VIX, yeah. So I know that one is highly negative to all these other stocks. When there's a lot of volatility, the VIX will jump up and the stock market, all of these Dow components, certainly most of the market will be down and vice versa, right? When the market is up, then VIX is going to calm down, right? So this is pretty dangerous place to be, VIX, but I just wanted to include it just to show you that example right there. Okay, so moving on, we can see a good example of all the correlations. So I printed it out over here, and now I'm going to look at visual representation of that same correlation heat map. And you can see right over here, there's a strong negative correlation. So anything dark red is going to be negatively correlated. You can see the what is this called on the right? I always forget the name of these things. The chart or something. Not really a chart. It illustrates what's in the chart. Anyways, this color bar on the right shows you that the highly negative correlated stocks are represented in red, and highly positive correlations are navy blue, and then you have a whole range in between here. Okay, so we can go ahead and create some new features in our data frame. Okay, so this is called feature engineering. So I'm actually calculating a few brand new features that didn't come to me from the source data, but that's okay. I can go ahead and calculate portfolio returns, the 3-day rolling average, 7-day rolling average, month average, 3-day, or the mean average, 3-day, mean average, 7-day, and then the overall momentum, which is portfolio return minus portfolio return shift, right? So we're looking at the momentum. Is this increasing? Is it decreasing? Is it moving up or down or whatever it is? And there's a couple more new features too, future vol and target. And I can go ahead and create a machine learning algorithm. So I'm going to have two features that I'm going to drop from my independent variables, because I don't want the machine to look at these variables and know what they are. I want it to look at the variable and make a prediction into the future of what this is going to be. And remember, this target variable is future vol greater than the median vol right here. Okay, so I want to say, is the volatility increasing or decreasing? And if it's greater than the average, then I want to know about that. Okay, so we're going to get more and more volatile over time, or less volatile. I don't know what the case is going to be, but I want to be able to try to make this prediction. Okay, so these are going to be the independent variables, which is everything that I created over here, plus the original data set. And then the target variable is what we're trying to predict, right? So that would be the Y variable or the predicted variable right there. And I am going to use Random Forest classifier to do the prediction for me. So I go ahead and feed that into the model. Okay, and I'm doing a fitting the model right here, and then making a prediction, and then printing out the results. And I actually use two, so I have a Random Forest classifier and an XGBoost classifier. They both do a very good job of making predictions into the future. This is the precision recall and F1 score that the model was able to achieve, right? So we know how well the model can learn and to make predictions. And in this case, it's about 65% accurate. And here, with the one case, this is the binary outcome. So remember, with a classifier, you have some type of labeled data or some type of binary data, like true, false, yes, no, on, off, things like that. So we're trying to predict the target. Is the target going to be up or down? That's what we're looking at here, okay? And this, again, is based on future volatility greater than the median future volatility, okay? So I want to see if there's increasing. Is it increasing? Is it decreasing? Is it slowing down? Is it accelerating? I want to try to make that kind of prediction, okay? So we can see which features have the most impact on the target variable. This is called a feature importance exercise. And we can see the overall return has the most impact on the target variable, which again is this guy right here. So the feature target, which is future volatility greater than the average or the median future volatility, not the average, it's actually median. Mean, median, and mode, right? Mean would be the average, the median is the most likely, and the mode is the most frequent occurrence or something like that. I forgot now. I have to look that up. Anyways, so we see what the target variables, which features have the most impact on the target variable. Its return, the volatility 3-day rolling momentum, moving average 7-day, moving average, or the vol 7-day, and then the moving average 3-day, and then this is a percentage of importance. So here it's almost 25%. You can add this in. That's another almost 20. That's probably close to 40%. And then add in these two, that's probably another 70%, 80, 90. And then you can see here, you're counting for about 90% of the movement of the target variable just from these 6 independent variables right here. So I think that's pretty cool to be able to do that. Predicting whether the market will be up or down tomorrow with probabilities. So again, we have the model down here, the Random Forest classifier, and I want to make predictions. Is the market going to go up or is it going to go down? And what's the probability of that outcome? That's what I want to know. Okay, so probability that the market will go up tomorrow is about 64%. Okay, so 64% chance of an increase, again, based on what the model was able to learn from, what it was able to learn from the historic data, and we're making predictions into the future. And this is perfect? No. And the market can respond very with a lot of uncertainty, with a lot of ambiguity, and you don't know, but there is a good chance that when the market opens on Monday that it's going to be up 64% chance of an up market. Okay, so one more thing that we can look at here is analyzing portfolio reaction to momentum, volatility, and mean reversion. So remember, mean reversion, if the market goes up, it's probably going to come down. If it goes down, it's probably going to come up again, right? You always revert to the mean. You always go back to the average. Typically, and there's exceptions, right? Like WorldCom, Enron, Bear Stearns, Lehman Brothers, right? Those did not return to the mean. They just went out of business and they collapsed very quickly. But with most legitimate, like fully functioning businesses, they do return to the mean, right? So if you see a big dip in a stock, it's probably a good opportunity to buy. So, and likewise, if you see a huge jump up, maybe it's time to sell, right? Take your gains and walk away, because more likely than not, that stock will revert to the mean. They tend to do that over time. So here we have a 1-day lag, 2-day lag, drawdown flag, and then rolling Sharpe ratio. So the Sharpe is the return minus the risk-free rate divided by the standard deviation. I believe that's how you calculate that. All right, so that shows you the risk-adjusted return over time. So if you have a stock that's very, very risky, it's generating a lot of returns for you, but it's super risky and you can't sleep at night, Is that really a stock you want in your portfolio? It might not be, but it may be, right? It really depends on you. But the Sharpe is important to show you the risk-adjusted return. So if you're making a lot of returns, that's great. But if you're taking on massive amounts of risk, that's not great, right? So you have to adjust your returns by the standard deviation or the variance of the returns too. So okay, so now we're moving on to model prediction and probability that market will go up tomorrow. Control Enter to refresh the cell. So we have the timeline here with everything plotted out, and you can see the up and down movement. And again, it tends to revert to the mean, right? So you go up, you go down, and you bounce around, but you don't have these big, long, continuous run ups, and you don't have these big, long drops off, right? So it tends to stick pretty close to the mean. And then we have over here example of signal strengths over time, momentum, volatility, and then again mean reversion. The mean reversion is very interesting. I like this concept, and I love these charts. So you can click on it and you can interact with the chart and turn these things on or off, right, to customize the view that you want to work with. And then of course you can zoom in and zoom out. These are very interactive and very dynamic types of charts. I like these plotly charts a lot. Okay, and then we can visualize the rolling Sharpe ratio and the drawdown flag together. Okay, so here's the drawdown flag, here's the rolling Sharpe, and again, like you can see the bounciness and the up and down and the choppiness of this data. But again, like it always comes back to the mean, almost always. Like not every single stock will do this, but the point is, if you see a big drop in the market, like we saw one day last week, I think it was Monday or Tuesday of last week, there's a big sell-off of 2,000 points in the Dow, and people are getting scared, okay? But long-term, like the Dow and the S&P 500 and the NASDAQ have always outperformed almost any investment strategy. I have videos on that. You almost can't beat the S&P 500. If you take some money and put that into the S&P 500, you won't really have to do a whole lot. Just sit and wait. That's all you have to do is wait for this thing, and you'll make very decent returns, very handsome capital appreciation, and you don't need a very sophisticated investment strategy. You don't need like a very expensive portfolio manager, right? I mean, these people add some value. They will add value in terms of diversification and professional money management, but in a lot of cases, you can do this for yourself, right? You can empower yourself to become pretty wealthy by investing in the stock market, but don't get spooked by these big events when the market drops significantly. Don't sell everything and run for the hills. That is the worst thing you can do, right? You want to stay probably invest more if the market goes down, because you can buy in the dip, and now everything's getting relatively cheaper than when it was when stock values are much higher. Okay, so that's it. That's what I wanted to show you. This is number 3 in a series of 5 about financial market risk assessment. Okay, so that's it. I'm going to wrap it up, and I will see you guys in the next one. Bye.